Good day. We are the Group 5 and we are going to discuss about Module 5 entitled Credit Policy and Credit Application. Before we proceed, let me introduce the members. Mr. Unson, Miss Ladines, Mr. Nicholas, and Mr. O'Rio.
Introduction. Crafting an effective credit policy blends art and science, considering factors like corporate culture, margins, competition, inventory, and seasonality alongside financial analysis. Key aspects including determining credit limits, payment terms, down payments, and criteria for evaluating new customers. Additionally, it's crucial to establish a procedure for handling late payments, unauthorized deductions, and bad debts, seeking advice from professionals to minimize the credit risk. Factors influencing credit policy. Number one is competition. Competition shapes how companies set their credit policies. Credit availability is crucial in competitive industries. A company's credit policy is a key for staying competitive. Even in industries where credit isn't a primary tool, companies can use it strategically to gain an edge over rivals. In essence, credit practices reflects and influence competition within an industry. Number two is customer type. Customer type significantly influences industry credit policies. For businesses with limited capital, overly strict credit terms can drive customers away, leading to market loss. Adjusting credit policies to match customer financial constraints is crucial for staying competitive. Number three is merchandise. Merchandise is a type shapes credit policies. High profit or high price items often lead to lenient terms. If merchandise can be repossessed or returned easily, terms may be more flexible or shorter shelf life. Items usually have a shorter credit periods of mitigate risk, like the terms in the food industry. Number four is profit margin. Profit margin impact credit decisions. Narrow margins leads to cautious account selection, while higher margins may result in approving sales to risk accounts. Number five is unit price. Uniform liberal policies are simpler to implement for low-price merchandise. Even if a decision is wrong, the risk is lower due to the lower dollar amount involved. However, a more thorough analysis typically occurs before approving customer orders to mitigate credit exposure. Number six is geographical distraction. Geographical distraction of customers affect credit policy. Distance markets require adjustments in credit analysis and collection efforts. Concentrated markets have unique price competition and service needs. Number seven is government regulations. For certain commodities like spirits and liquors, government regulation dictate credit policies for sellers, which must be followed. Overall policies must align with these regulations. Additionally, broader economic trends influence credit policy decision in general sense. Number eight, economic conditions. Economic conditions play a major role in short-term credit policy. In prosperous times, debtors have better ability to pay but may overbuy during downturns. Debtors delay payments and credit standards may tighten. And declining sales pose challenge in maintaining volume while selecting creditworthy customers becoming more critical. The importance of written credit policy. Number one, a written policy provides a structured approach to risk management and the debt collection process. Number two is a written credit policy provides a certain amount of consistency, which is important to the department's reputation. Number three is it helps ensure a consistent approach among customers, reducing the chance of personal bias affecting the decision-making process. Number four is a written policy can be reviewed by senior management and either accept or modify.
Formulation of loan and credit policy. So, formulating a loan and credit policy involves creating a structured set of rules and guidelines that govern how financial institution or lending organization extends loans and credit to borrowers. So, contents of loan policy. So, the first one is size of a loan account. So, the size of a loan account refers to the total amount of money that the borrower has borrowed from a lender. It represents the principal amount of the loan, which does not include any interest or fees that may be associated with the loan. The second one is credit for infrastructure. Credit for infrastructure refers to the financing provided to support the development, construction, or improvement of infrastructure projects. Infrastructure encompasses with range of physical assets and systems that are essential for the functioning of societies and economies. This includes transportation networks, so such as roads, bridges, airports, ports, and railways. Energy infrastructure, so such as power plants, transmission lines, pipelines. Water and sanitation facilities. So telecommunications, networks, and social infrastructure such as schools, hospitals, and public housing. So, what is type of loan? Portfolio. So, a loan portfolio is a collection of all the loans held by a financial institution such as a bank or credit union. These loans are typically categorized into various types based on different criteria. So, this is a types of loans. The first one is consumer loans. So, extended to individuals for personal, family, or household purposes. This category includes various types of loans such as personal loans, auto loans, student loans, and credit loan. So the second one is commercial loan. So provided to businesses for various purposes related to their operation, growth, and investment. The example of this is term loans, commercial real estate loans, and lines of credit. The third one is real estate loans. So, real estate loans include both residential and commercial mortgage used to finance the purchase or refinance of real property. So, the example of this is residential mortgage and commercial mortgage. Next is construction loans. So, construction loans are short-term loans provided to finance the construction or development or residential or commercial properties. These loans are typically repaid upon completion of the project or through permanent financing. This next is Small Business Administration loans. SBA loans are loans guaranteed by the Small Business Administration, which provides financing to small businesses for various purposes, including working capital, equipment purchases, and real estate acquisition. The last one is specialized loans. Some financial institutions may offer specialized loans products tailored to specific industries or purposes such as agricultural loans and healthcare loans. Acceptable security. So, acceptable security refers to the assets or collateral that borrowers pledge to secure a loan or credit facility. Lender required security to mitigate the risk of default and loss in case the borrower fails to repay the loan. The acceptability of security depends on various factors, include the types of loan, the borrower's creditworthiness, and the lender's risk appetite. Maturity. So, maturity in finance refers to the date on which a financial instrument such as loan, bond, or certificate of deposit becomes due or repayment. It represents the end of the term or duration of financial obligation after which the borrower is required to repay the principal amount borrowed, along with any accrued interest or other applicable fees.
To establish an international credit policy. Organization must assess the credit risk associated with extending credit to international customers, considering factors such as political stability, economic conditions, currency exchange risk, and customer credit worthiness. Legal and regulatory compliance is a crucial as is establishing clear credit terms and conditions for international transactions. A robust credit approval process is essential considering factors like financial statements, credit reports, trade reference, and bank guarantees. Credit insurance can mitigate non-payment risk due to insolvency or political events. Currency management strategies can be developed to manage currency exchange risk. Efficient collection procedures should be established considering cultural differences and legal constraints. Building strong customer relationships based on trust, transparency, and mutual respect is essential. Monitoring and reporting systems should be implemented to track credit exposures and generate timely reports. Continuous improvement is necessary to adapt to changing market conditions, regulatory requirements, and lessons learned from the past experience. And we will proceed in international credit policy. To evaluate credit risk by considering factors like political stability, economic conditions, currency fluctuations, customer credit worthiness in international markets. Ensure adherence to international trade laws, regulations, and sanctions, and understand legal frameworks governing credit transactions across different jurisdictions. Define clear terms, conditions for international credit, including payment schedules, credit limits, interest rates, and penalties for late payments. Implement a robust process to assess the credit worthiness of international customers incorporating financial analysis, credit reports, trade reference, and bank guarantees. Considering obtaining credit insurance to protect against non-payment due to insolvency or political risk in foreign markets. Develop to manage currency exchange risk, such as hedging or natural hedging techniques to mitigate the impact of exchange rate fluctuations. Establishing an efficient procedure for collecting overdue payments from international customers, considering cultural differences and legal constraints. Crafting a comprehensive international credit policy that addresses these points can help businesses navigate the complexities of global trade and minimize the credit risk of exposure.
Good day everyone, I'm Arizi Oreo and for continuation of international credit tips, let's proceed. To streamline sales and credit, shift to new accounts on cash in advance or letter of credit terms. Also standardize guidelines for open account sale to prevent conflicts between sales and credit. And then use letters of credit that meet seller criteria and incorporate them into international sales, contract, or cost savings. By using international account receivable insurance for longer terms and larger credit limits, credit insurance is recommended for marginal customers and high-risk countries. And consistently communicate with international customer even when payments are late to reduce conflicts and ensure they understand the department cannot compete. This will help customers understand that they cannot play department against department. Comprehensive handbook for the sales force should be developed to provide accurate quotes, including letter of credit terms, open account terms, wire transfer information, and credit card use. And old policies can should be rewritten to be more user friendly, and the credit department and should handle establishing terms of sales. A credit risk model can be created to score customers audited financial statements, determining if specific customers can be offered open account terms or secured terms. Unit heads should be involved in determining whether to accept or reject unusual terms and condition of sales. Innovative Innovative international financing program can help the salesforce meet goals without increasing credit risk, especially for especially for those selling in the Far East. Upper management should identify customers who work with other company units and involve them in developing a unified approach to establishing credit limits. The goal is not to overextend without realizing it, ensuring reasonable amounts of credit and extended. And now, let's go on summary. When creating a credit policy, must thought should go into it. Credit control should not develop into a office dedicated to preventing sales. Enforcing a credit policy so stringent that bad debt is decreased by the benefit of not conducting business. On the other hand, if the policy is overly lax, sales will plummet. Conducting business with anybody, no matter how much money they have. There should be a clear procedure for opening an account for new clients, which should include a credit check. Numerous internet resources are available to offer information that will assist in determining a client's credit worthiness. In order to reduce trading risk, a credit limit should be established in light of this, ensuring that the new clients provide all necessary information is a key component of the account creation process. It's surprising how frequently credit is granted without the recipient's legal identity being known. And also, continual credit checks should be performed on new customer on a frequent basis. Based on the degree of risk associated with the account, it's likely that you will want to raise credit limits for consistent customers with a track record. Customers' health will change over time. Therefore, it's critical to identify warning indicators early on to lower the risk of business collapse. There are already credit checking programs that easily link with your accounting system to give your consumers real-time risk indicators based on amount of credit they have been granted them. And that's all. Thank you.